Options trading, the fastest way to blow up your account or the fastest way to get rich. In this video, I'll be showing you guys my option strategies, how I've been successful, and a bunch of lessons that I've learned through trading options and mistakes not to make, things to do, and my personal strategies that I use with trading options and how I use options, what my strike prices usually are, what my expiration dates usually are, and just going to show you guys a deep dive into my head and my brain of when I do options and how I do options. Options are such a powerful leveraging tool that I think all investors need to know how to use these. You need to be very cautious with these because you can lose so much money so fast. But using options the right way can result in some amazing gains. And on these high conviction trades, using options can multiply your gains by hundreds of %. So it is so important to know how to use these options when needed. In this video, I'll be going through the basics, and then I'll be going through some advanced techniques that I use while trading options. So let's get started. So first off, let's talk about what an option is. So an option contract gives you the right to buy shares. So for example, if I was to buy an option contract on Facebook stock, so options give you the option to buy or not to buy each share at a certain price that is predetermined. So for example, if you were to buy a call option on Facebook, and let's say right now it's $200, I'm just making this number up and just using this for an example purpose. So saying that Facebook is $200 right now, and you place an option that expires in August. So that's 3 months from now, and let's say the strike price is right in the money, which would be $200. So this gives you the right to buy 100 shares of Facebook stock at $200 no matter what the price is in the beginning of August. If your expiration was on August 1st, let's call it that. So essentially with an option contract, you can control 100 shares with much less money than you would if you were to buy the shares outright. So in this situation, if you bought 100 Facebook shares, it would be about $20,000 if you bought regular stock. Now if you purchase an option contract, you're just paying a premium to own this contract. You're not owning any of these shares yet, you're just owning the option to buy, so you're just controlling the movement of these shares. So for example, let's say the premium on this is $1,500. So instead of paying this $20,000 to control these 100 shares that you already own, you're paying $1,500 to control 100 shares that you don't own, but you're controlling the option to own. Now with options, your money will multiply really fast if your betting goes the right way, but if it goes the wrong way, this amount will drop significantly. Personally, when I was beginning to invest in options and to try out options trading, I made a ton of mistakes and lost a ton of money so quickly. There were some days that I lost like $1,000. It was a very rough time, but because of those losses, I learned how to master my tactics with options and how to not make mistakes again. I highly recommend you make a log every time you buy an option and sell an option, and everything you learned, whether it was a gain or a loss, write that down because it is essential for your future. Once you have more money to have higher positions in options with, make this list and then you can look back and make sure to not make the mistakes that you made before. Each loss is a lesson, always remember that. So like I was saying, when I was a beginner, I lost so much money with options because if you make the wrong decision and you place a super risky pick and it goes down that same day, you can lose 50% of that position so quickly. So some of the most risky options you can do is having an expiration date that is soon. So let's say it's Monday and you buy an option expiration on Friday. Usually option expirations will be on the Friday of each week, so you can pretty much pick which week you want out. So there is something in these option contracts called theta, which is also known as time decay. So this means that if I was to buy an option that expires next Friday, which is very soon, each day that passes, so let's say that the stock doesn't move at all within the first 3 days. So each day that passes, this option contract is losing value because the expiration is coming up, because you're going to have to exercise the option on that Friday. So let's say it's Wednesday and the stock has not moved yet, this option contract price will go way down because it's expiring so soon, and people will have kind of bet on it going up within this short time period. And if it doesn't go up within the short time period, even if it doesn't go down or it goes up a tiny bit but not enough, you will still lose money on this option. So something to always be aware of is time decay and what your thesis is on each option and how long you are planning to hold each option. Always have a trade thesis, always have an in and out, always have a plan to get in and to get out of every single trade that you make with options. So I'll talk about the difference between a call and a put option. So call option contracts are pretty much regular contracts. Like I was saying, if you're betting on Facebook to go over 200 and it's 200 right now, let's say I place a put option next Friday at a $200 strike price where you'll buy the shares at when the option expires. Let's say I place a contract on $200. In the same example, let's say this coming Friday I'm placing an option, a call option on Facebook for $200 and the stock price is $200 right now. So if the stock goes up, the more gains you will have because you're essentially buying these shares at $200 and selling them at the price that it is on that Friday. Now you can always trade options before expiry, which is what I always do. I never hold an option to expiry, and I never fully exercise these contracts because it's not worth it to me, and it usually trades at a premium, and I always like to get the most I can out of the time premium that I do have left. So a call option is essentially betting on the stock to go up, and the opposite of that is a put option. Let's say the same situation. So with a put option, you're betting on Facebook to go down. So let's say you're playing it in the money once again. It's $200, you're placing a $200 strike price put option expiring this Friday. So if Facebook stock goes down throughout the week and you have that strike price of $200, let's say it ends up on Friday at $190. When the stock price is $190 at the end of the week, instead of having to buy these 100 shares at $200 like you would with the call option, you have the right to sell Facebook stock, which is $190, at $200. So you secured that selling price of $200. Essentially, you're betting on the stock to go down, and the more money you make the difference of. So let's say Facebook stock gets down to 180. You make a $20 difference on each stock since your strike price is 200. 200 minus 180 is $20. So you essentially make $2,000 because you're betting on that stock to go down, and you're controlling 100 shares because each contract is worth 100 shares of the stock. And if you end up the week, the stock price is down to 180, you sell these 100 shares at $200, and then profiting the difference between 200 and 180, like I was saying. So that's the difference between call options and put options. And my strategy with put options is, unless I see a huge bubble, I actually place the put option on Virgin Galactic, ticker symbol SPCE, and that was one of my big plays. So unless I see a play like this, where it's a clear bubble and there's no upside, in my opinion just clear downside, I usually stay away from put options because I hate betting against the market fully. It's okay to hedge your portfolio, like with a Dow put or a SPY put, and just for a safe hedge, but I never fully go into betting on the market going down unless you're super bearish on the stock, such as I was with Virgin Galactic earlier this year. So those are my thoughts on put options and a quick explanation of what options are, and I hope you get a basic idea from that. And now I'll go through my techniques that I use to trade options. So first, my strategy on strike prices and expiration dates. So what I do for my strike prices is I usually make them slightly in the money, whether I'm placing a put option or a call option. This maximizes your upside and lowers your downside. So let me explain on that real quick. So if your option was to decrease, and let's say you have that $200 call on Facebook, it's expiring on Friday, it goes down to $195 on Wednesday, and you're like, shoot, I gotta get out of this. Your strike is at 200, so there's a chance that it goes up past 200 still, because it is still close to the price that it's at. So you're limiting risk because this contract still does have value. Now if you were to make a buy that was way out of the money, so let's say your strike price on this Friday was $220 for Facebook stock, that was $200. It goes down to $190 on Wednesday. There's almost no chance that it goes up past $220 on Thursday and Friday. So in that case, the option is almost worthless, and you pretty much lost 100% on that contract. You may have lost like 85%, but that's the reason that I place my options slightly in the money. And for my expiration dates, it depends on my thesis. So if I'm using this as a quick bounce back play, I'll just have a contract that expires the next week. But if I'm using this as a long-term play and I believe it has crazy long-term upside, I'm just looking to maximize the shares that I control, I'll do like 2, 3, 4 months out just to control these shares for a longer time and get more potential gains. So expiration dates always depend on what your thesis is. Always have a trading plan, when to get in and when to get out, and what your full thesis is. This is super important to know your thesis behind everything. I cannot preach that enough. Okay, so now let's get into option strategies that I use all the time and when I place options. So the first strategy I'm going to be talking about is the bounce back play. So a lot of the time I'll place call options on stocks that got oversold like crazy. So for example, this is one that I did just yesterday. On Friday, Facebook stock, we saw this drop 8%. I bought a call option expiring next week because personally, I believe this is an amazing company. I believe that it was oversold on Friday. There's an overreaction. There's a lot of companies boycotting Facebook ads, but I believe that the 8% was an overreaction sell-off because every reaction in the stock market is an overreaction. You always got to be aware of that. So this overreaction sell-off allows for a quick bounce back, and each percent is such a big gain when your expiration date is happening soon, and you can just get crazy gains from soon expiration dates and quick bounce back plays. So stock that drops like 30% one day, they have a bad earnings, I'll sometimes place a call option on this if I have a high conviction, and then use that as a quick bounce back play. So let's say it's dropped 30% one day. The next day I may buy into a call option, make it a pretty quick expiration date, 1 week or 2 weeks out. And like I was saying, every reaction in the stock market is an overreaction. Always be aware of that. And then after this overreaction happens, there's usually a slow run up. So let's say it drops 30% and the next week it's up 5% slowly because it's slowly gaining back what the price should be. So in this case, your option may gain 50 to 60% because of this 5% gain and because people were betting so hard on the stock going down and not going back up. A lot of these times the oversold bounce back plays are such easy money. So those are some of my favorite options to place and one of my option strategies to do. So the next situation that I'll place option contracts is when I have a high conviction on a trade. So for example, I've been having a high conviction on Peloton for so long, and on the Peloton earnings call that was in May, I had a very high conviction, so I had a bunch of option contracts leading into earnings. And this way I maximized the amount of shares that I could control with a smaller amount of money. So I pretty much had half of my portfolio in Peloton, and because of these contracts, I was able to control over 1,000 shares with just like $3,000 to $4,000. If you were to actually own these shares, you would have been paying over $30,000, and instead I was paying $4,000 and still got the same amount of gains that I would have had if I was just owning that plain stock. So that's the reason that I use options to leverage your money and to just maximize your upside. So currently I have call options on Fleer and on Jumia because I believe that these are high conviction trades for me. I've been doing a lot of Peloton calls as well, kind of selling in and out of them because the call options are very volatile on that one. But I've been making a ton of gains, and all these high conviction trades, I just love pouring a lot of money into options because this way you just maximize your upside. And when you have conviction, this means that you believe that there's like a 90% chance that you'll be successful on this trade. So why not maximize your upside in that situation? And that is something that I always do, controlling options. So the final one that I always use option contracts on is these catalyst plays. So for catalyst plays, this could mean that there's an earnings date, there's an FDA approval date, or there's a big meeting for the company, or like in Tesla's case, a battery day type meeting. So something like that gets investors excited. You can have call options leading into these situations, but I want to make one thing clear. I almost always sell out of these options before the hype date happens. So let's say that there's an FDA approval date happening on June 10th. I'll either sell my option contracts on June 9th or June 10th, and this is because if there was something bad to happen at earnings, if there's something bad to happen at the FDA approval date, then you just take profits, and no matter what happens, you don't have to lose a ton of money. And the second reason, so even if there is a ton of gains, even if there is successful earnings or successful FDA approval date, the implied volatility is key. So implied volatility is a measure with options that raise the price. So the very volatile stocks, these usually have a higher premium because these usually go way up and down and people can trade them very easy. So these trade for a lot more. And once these dates are gone, that implied volatility goes almost all the way away. So let's say there's a drug, it has the FDA approval date on July 10th. It has a successful approval date and the stock goes up 2%. So let's say a solid 2% gain. Chances are you still lose money on that option contract because the implied volatility took such a big hit that it made the option contract go so far down. And even though it was a successful approval, this doesn't mean the premium will go up. It's not like stocks that just trade straight based on stock price. This trades on volatility, this trades on excitement, and this is a leveraging tool. So I almost always sell out the day before earnings, or the day before an FDA approval date, or the day before an investor meeting. Taking your profits is one of the most important things you can do with options, because one day you can have $500 profits, the next day in that same contract you can lose $1,000. So this is why I always take gains on options. Even if I believe there's more upside to be had, it's always better to sell too early than too late. Always take your gains. That's something that I preach with penny stocks as well. Always take your gains. Don't hold too long unless you have a long-term conviction level, because kind of like options, penny stocks just trade super volatile, and one day they can be up 50%, the next day they can be down 50%. So that's something that you always gotta be aware of. And taking gains is something that I always preach. Always take profits if you believe that there is substantial downside. So one more thing with options, always be careful with options that have low volume. So let's say there's a tiny drug company, you have the FDA approval date on July 10th, and you're leading up to July 10th, but this stock has crazy low volume, there's just not a lot of buyers of these options. And if you're doing the strategy that I was saying, where you sell out before the approval date, it is super hard to sell these options at a good price because there's so few buyers in these situations, and in these stocks that don't have a big option volume, it's so hard to buy, so sometimes you have to sell at such a lower price. So always be aware of the option contracts that have low volume, and these are very risky. Even if you're high conviction, sometimes it's just better to go with straight shares. So those three strategies are the strategies that I usually use to maximize my upside and to just place options on. And I highly recommend that you develop your own option strategy and learn from as many people as you can. Learn as many lessons as you can trading options, whether it's gains or losses. Take notes, because options, once you master options, you can make so much money. And you can also lose so much money if you make the wrong decision and if you're not educated in the options world. So if you want 2 free stocks on Webull, the link's in the description. This offer ends at the end of June, I believe. Get your 2 free stocks. One is valued from $14 to $1,400. Webull is a great platform. I highly recommend you get that free money. Even if you want to move the money over to another broker, just get that free money and then move it. Also, if you're looking to join the stock group, it's $9.99 a month. You get a portfolio update every single day, and I send messages every time I buy and sell a stock. Now in this group, I don't tell you to buy and sell stocks. It's mostly for educational purposes, and I let you know what I'm doing so you can base your own theses off that. And I just kind of give you investment ideas to look into yourself and to do your own research and due diligence. You always have to do your own research no matter what, and never blindly follow any investor, no matter how accredited they are, because you have to know your thesis. And knowing your thesis, this means you'll know when to sell, you'll know when to take profits, and you'll know when to hold so you don't sell for such a loss. So you always got to develop your own strategy and always develop your own thesis. Never blindly follow somebody, because you never know what they're doing. Alright, I hope you guys found this video very beneficial, and keep up that grind on the research, on the due diligence. We're making a ton of moves. There's a ton of moves upcoming this week. There's so much opportunity to be had. So it is so important that we find these opportunities, uncover them all, and just act upon them and get some crazy gains this week. Alright guys, thanks so much for watching. Let's get rich.